HUL's parent company Unilever on December 17th cut its sales growth outlook for 2019. Now, this came as a surprise for investors, pulling down both the stocks. Let's do a three-point analysis to find out what should investors make of it. 1. Reasons behind the cut in growth forecast. Well, Unilever has cited economic challenges in South Asia and tough trading conditions in West Africa as the key factors behind the downgrade. The company's earlier sales guidance was at the lower end of 3 to 5% multi-year range. It now believes the sales for 2019 would come even lower. Not just this, Unilever doesn't expect a swift recovery as well. While it expects H1 2020 to be better, growth is still expected to be below 3%. Now, a recovery is expected in H2 of 2020, which could take the full year guidance to the lower end of 3 to 5% multi-year range as well. Now, emerging markets excluding Latin America contribute about 46% to Unilever's sales, and HUL roughly contributes close to 7% of Unilever's sales. Now, when we look at the quarterly sales performance for the past 8 quarters, it becomes quite clear that a large part of the deceleration in the emerging market space may be actually due to the demand slowdown in India. Now, in the quarter gone by, HUL's sales slowdown reflects lower offtake in the rural areas. 2. What are the implications of this on HUL? Well, given HUL's share in Unilever's growth, there could be a gestation of 3 to 4 quarters before the volume growth recovers up to low double-digit figures. Now, the other interesting takeaway is that there is no potential adverse impact on the earnings, margins and cash conversion. This means that the company seems confident of staying ahead of competition in spite of the challenges in a few markets. So, we take a contrarian point of view that HUL need not pursue any aggressive pricing-led strategy in coming quarters, except for the pockets where downtrading is visible, which is in soaps and toothpaste. 3. What should be investor strategy now? Well, HUL has corrected about 12% from its all-time highs, and further consolidation is not ruled out in the near future. However, we remain positive on the stock for the medium term and see it as the most well-positioned FMCG candidate to ride out the current slowdown phase. Also, rural demand is likely to improve on better outlook for the Rabi season. We see the FMCG major to be ahead of the pack in capturing this incremental demand. The stock can be accumulated on the declines.